It can be coming from two sides. It can be that the index variance is too high or the individual variance is too low, right? So that implied correlation is too high.
Hey everyone, today's podcast episode is actually sponsored by us here at Predicting Alpha. If you're an ambitious options trader who understands that data is the key to building a profitable trading strategy, all you need to do is click the link below. You'll get 14 days of free access to everything you need to take your game to the next level. You're going to get the education that will teach you how to think like a quant and what trading with an edge really looks like. You'll get the data you need to go out and actually find a real edge in the market. And you'll get to meet a community of like-minded traders who work together to beat the market. If that sounds good to you, just click the link below. 14 days, no obligations. It will change the way you think about trading forever. With that being said, enjoy the show.
Living in Germany now, being a professor in the Frankfurt School of Finance and Management, but basically being involved in some kind of trading activity for the last, 30 years, 25, 30 years, so pretty long. I started my path in Russia a long time ago as a trader in a bank, and I was trading some forwards and options on the Russian markets, very exotic activity. Then I decided after the Asian crisis of 98, 99, decided to go and study, basically went to the States, spent a couple of years in Rochester, upstate New York, doing my MBA. And then I was deciding what I want to do, if I want to go to the industry. And I spent my summer internship in Merrill Lynch in amazing groups, like structured solutions group, structuring all kind of derivatives, very, very interesting. Or again, another choice would be probably to continue my learning experience. And then after this amazing summer in Merrill, when I felt like a very, very small piece in a huge machine, I decided let me better switch from the dark side to the science kind of white side. And I decided to continue studying. So I went to my PhD in INSEAD in France. And after my PhD in France, I went directly to Germany. I spent a couple of years in Goethe University as an assistant prof. Then I spent some time in Mannheim as a professor. And then I joined this private business school in Frankfurt, which is Frankfurt School of Finance Management. My research is mostly devoted to options and extracting information from all kinds of derivatives markets for trading, for computing, and for measuring risks, for computing different risk measures, for portfolio management, and so on and so forth. Last couple of years, I've also been involved in several projects related to climate. So it's a big hype now. So everybody has to write something, and we've been quite successful. Combining some NLP, so natural language processing, and earning calls, and basically producing a measure for ESG or climate exposure of individual companies. And then also wrote another paper on how this measure is priced in stock returns. And that's basically it. So in addition to my academia, as I said, I've been involved in trading. So I've been running for many years, kind of very small private fund. It's more like friends and family fund. I'm doing lots of trading, both discretionary and a little bit of systematic, mostly on the US markets, and mostly equities and options, some futures, but actually not so much. So that's a couple words about myself. So I'm really happy to be here and discuss any questions you might have.
Awesome. I think where I'd love to spend the majority of the time is probably talking about the balance between academia and practitioner. Because it's awesome to see you doing both. I think that's sometimes a rare combination when you're looking at research. It's usually someone either just like really focused on trying to prove a phenomena, and then it's up to you to figure out how to trade it, versus someone who's got a perspective from both, and maybe can give some insight into that. But before we jump into that, what the paper that we found from you that led to this conversation happening had to do with implied correlation. And in some of the more advanced education we provide to members, we talk about implied correlation as one of the topics covered. So do you want to maybe give like a rundown on what you were doing looking at implied correlation and some of your findings?
Implied correlation is, I believe, a very interesting topic. And it used to be very important probably 10 years ago. Then it lost some importance after the financial crisis. Okay, another financial crisis, 2007, 2008, just because the market dried up in this space, and now it's not so easy to trade in this direction. But in any case, this paper was actually my first paper, which I wrote with my supervisors in INSEAD, and we published this paper pretty highly in Journal of Finance. And what we documented that there is a correlation risk premium. So basically, if assets are exposed to high correlation, right? Or let's rephrase it differently. If assets allow you to hedge correlation risk, right? So they allow you to hedge something which against the situation in which you lose diversification, then you have to pay more for this kind of assets, right? So there's a negative risk premium for the correlation. We have documented that this phenomenon is relatively robust. There are also several papers by our colleagues from Imperial College and some other universities which show that correlation risk premium holds in every country, right, around the world, in most countries around the world. So it's a pretty robust phenomenon. How it is used, how it can be used in trading, truly the only one application which we found, but which is also extremely robust, is predictability of the market returns or some large index returns with the implied correlations, or also with the correlation risk premiums. It's a little bit weaker, but okay, theoretically, we should be predicting future market returns with a correlation risk premium, but the implied correlation by itself works better in this case. So I know there is some work by my former PhD students who also try to use it in trading, implied correlation, by modeling risk-on, risk-off regimes. So basically, they estimate some kind of regime switching models on implied correlation, and then it gives a pretty robust signal also on the risk-on, risk-off. But in our case, I've been dealing a lot with finding good predictors of market returns, as I said. So variance risk premium, some skewness proxies, some option-based sentiment proxies, some volume proxies. Implied correlation has been working since our data started from option metrics in '96, and it still works. If you take variance risk premium, which has been very popular like 5-10 years ago, then it was predicting future market returns positively until last 5 years. And last 5 years, it's which sign is basically negative or insignificant. Implied correlation stays positive and significant. And again, it still can be used in this kind of application.
Yeah, and so you mentioned two things there, like sort of like overall market returns and like a variance risk premium, which I guess kind of go hand in hand to a degree. But are you basically looking at like buying like long equities when implied correlation is low, and then basically being short equity or no position when implied correlation is higher than, let's say, an average, if you're looking at like 2 years of data, let's say, or something, just to understand sort of the model.
Yeah. So when implied correlation is high, it typically leads to increasing equity risk premium in the future. So basically, when correlation is high, and it also typically coincides with some regimes when markets go down, right? Because we also know this asymmetric effect in volatility and the return, right? So when markets go down, correlation increases, implied correlation goes even higher typically because of the correlation risk premium, and then it would be predicting some recovery in the future and positive returns, positive risk premium. So implied correlation is high when there is high risk, but typically it also indicates recovery in the future. That's why it leads to positive returns.
Mm-hmm. Okay, so it's actually the opposite of what I was thinking. It's like when implied correlation's really high, that's when you want to be maybe buying equity because that's when
that's exactly what I said. When implied correlation is high, typically markets are down. So at this particular point in time, you would want to buy market because the market will start recovering in the future.
Mm-hmm.
That's what, and exactly that also coincides with the high risk state when the risk premium is the highest, right? Mm-hmm. So you want to get this risk premium in the future. That's why you start buying the market.
Right, but
it's almost.
Sorry, go on, Micah.
Sorry, I was just going to comment. So it's almost like a quantitative way of measuring when to buy the dividend.
Yeah,
right?
Yeah. Basically, it's also hard to guess when the correlation is the highest, right? So what is the right point in time when you should start buying equity? It's almost impossible, right? You should never catch a falling knife. We all know that. But still, when correlation is high, typically it means that the market will start rebounding in the future.
Yeah, so I guess that's, I was kind of going to take the conversation there where it makes sense that the risk premium is there, but sometimes it's there for a reason. So is there any way when you're maybe going for a more, like for the application of it, do you consider any like qualitative factors or anything else when you're in parallel to the implied correlation metric when looking at the risk premium?
There can be many factors, right? So we all know a very famous paper by Goyal Welsh, who considered lots of factors predicting future market returns or future market risk premium. Typically, in out of sample sense, almost nothing works. Okay, you certainly can consider many different factors. You can try to overfit your model, and you're most probably going to do that. But adding too many factors is also not good. We certainly can consider adding something to that. Right, you can add some macro factors. You can look at some term spreads. You can look at many different macro factors. But implied correlation has its perks, I would say. It is forward-looking, right?
Yeah,
and this is very important. You can also look at the term structure of implied correlation. So there are papers I know from colleagues from London Business School who looked in the term structure of implied correlation and were claiming that it also contains some signal. Right. Again, I cannot talk about it because I do not remember exactly the study, but there's probably some information in it. Right.
Okay.
But implied correlation, as I said, is pretty robust. It just works. It just works in predicting future returns, but it should not be used as a short-term signal. It's relatively long-term. Right. We talk about quarters, like probably 2 quarters, 3 quarters. It's not about 1 week. Definitely.
So one thing that I'm just thinking about here, one application we used, one trade that I had used implied correlation on in the last year was when implied vols in China, the Chinese ETFs really started to pick up, and we were doing something similar. We weren't looking at like what's going to happen in the next 20 days, let's say, but the position that we took, we were looking at the implied vol on the longer dated expirations, and it was more of like a change in implied volatility trade. So we were basically saying implied volatility will come down in the future. So we wanted, and we were trading, let's say it's like a year out options. Okay. Have you ever looked into that much? Like, do you see a similar phenomena as an indicator in, selling longer dated vol?
There is a very good signal, right? I guess many investors know about it. It's basically the term structure of VIX futures, right? So it is contango backwardation. It works pretty well, right? In terms of predicting the future volatilities and future returns as well. All right, so it also can be certainly combined with implied correlation in terms of risk on, risk off signal. But you see, all these concepts or all these variables are very much connected to each other, right? Yeah. So if we talk about VIX or just variance of the index, right? It is variance of composition of some portfolio of say 510 stocks, whatever, how many there are now with S&P. And then we have implied correlation. So what is implied correlation? Implied correlation is kind of intuitively the ratio of S&P variance and the average variance of the components of S&P, right? And that is the missing part of this equality, right? Of the portfolio variance or the variance of the index itself. Okay. So the higher is implied correlation, the larger is the wedge between the two. It can be coming from two sides. It can be that the index variance is too high, or the individual variance is too low, right? So then implied correlation is too high. Implied correlation is very high. So you certainly can just play this kind of analysis to try to understand what's going on and where this signal is creeping into the system, right? Is it coming from the index variance? Is it coming from the individual variances? Is it coming from the expectations that now all the stocks going to move together, right? So the correlation is increasing. And then when do stocks move together in the short run? Typically when we're falling, right? So we fall, everything moves together down, correlation is high. Now we wait for recovery. It's exactly the signal which implied correlation gives us that probably in the next month or 2 or 3, there will be some recovery, the markets would go up. Okay.
I love that you brought up, it's like, it's not always just that the ETF vol is high, right? Or the implied correlation on the ETFs is high. It could be that the implied vol in the underlyings is low. Sure. And right. So one thing that we, find challenging in the retail space sometimes is, if you wanted to trade both sides of it, it's a lot, it's very capital intensive, right? It's you know, there's it's you couldn't do this with, let's say, a $50,000 account, really. But so one thing that we try to talk about with people is, you know, trading the alpha leg of it, right? Which leg do we think will correct? And so when it comes to doing that, how do you sort of figure out whether it's the ETFs or the underlyings that is likely to correct? Do you have certain things you look at, or a checklist that you sort of go through to think through that problem?
Truly no. I sorry for the short answer.
Like,
but
I was hoping for some, like, so
no, you see,
close.
I personally not doing much of the dispersion trading, right? So what we talk about now, it's kind of dispersion trading, and there are lots of different swaps you can consider. You can just consider selling index variance, buying individual variances. You can also hedge out the individual vega risk. Then you get the correlation swaps. I mean, there are many varieties of that, and there are very good papers and the presentations from 10 years back which describes all these choices. But as you said, for the retail investors, doing dispersion is pretty hard, right? Doing correlation swaps is even harder because there are even more variables you have to take care of. You certainly can do it in a reduced form. Let's say you take S&P 500 and then you take the first 10 or 15 components, which probably cover, I don't know, 60–70% of the market cap, and you do only them. It's a good approximation. Right. So, for example, implied correlation index computed by CBOE is based on the 50 components only. Right. So they take the S&P 500 implied variance, and then they take the 50 largest components, rescaling the weights so that they add up to 1. So I guess it might work. But with the 50,000 accounts, I certainly personally would not do that. Right. Just because it's probably not just capital intensive, but transaction costs are pretty high. The bid-ask spreads are pretty high. You would need to rebalance the strategy quite a lot if you want to keep your exposures under control, right? If you want to just do it once and wait until maturity and hope for the best, okay. But if it works, theoretically, no. Empirically, it can, right? But again, whatever I heard from people doing that, typically the feedback is not extremely positive. So I don't know.
Okay, got it.
You know, we know the selling volatility because of the variance risk premium is typically a good and lucrative business. But again, here, dispersion trade is certainly less risky than just selling volatility, right? Because we're selling one volatility and hedging with the components of this volatility. So the residual is much smaller than the whole notional. But still, it's not an easy business.
Yeah. So you mentioned, you know, maybe not using 100% of the underlyings as a way to like replicate, for example.
Yeah.
And one of the challenges, so one thing that we've been interested in recently is looking at like foreign market ETFs as something to explore, maybe just because, you know, less liquidity and maybe a bit better for like a retail trader in terms of edge. There's just less eyes maybe. But one of the challenges is some of the underlyings aren't traded in like the US market, for example, right? So when we do that, it's, you know, one of the blocks that we faced is we don't have all the data for all the underlyings when calculating implied correlation. So is there a way to sort of fix this in your mind without having to figure out how to get all these pieces of data? Is there a certain threshold that you think is acceptable for replicating it, or maybe underlyings that make up a very small portion of the fund, like 1% of the fund or 0.5%, that we can discard of in this analysis? How do you think we can go about fixing this problem?
There is no theoretical answer to this question, right? So theoretically, we certainly can say, let's remove 10% of the fund and see what happens, like compute something and make some simulations. It's more like an empirical question, what really works.
Yeah.
Truly, is just my belief would be that removing 20, 30, 20, 25% of the fund, it's not such a big deal. But it probably depends on how homogeneous or how heterogeneous the variances in this fund are, right? So if it's a fund which is just industry-based and the variances are very correlated, right? So they're all driven by some systematic component, all of the variances of all the underlyings in this particular fund, then it's not a big deal, right? You can remove even half of them because all others will be moving the same direction as the ones which you removed. However, if it's a very heterogeneous fund from different countries, from different regions, from different industries, then the variances of, say, half of the components can be moving absolutely different directions compared to the variance of the other components. And then if you remove these other components and you only keep the first half, you'll be completely off the grid, right? It's just not going to, you will lose lots of precision, and certainly it's not going to be very precise in terms of approximation your final trade.
Got it. So when you're considering it, just so I understand, it's not so much how much of the fund do they represent, it's how correlated are they to the ones that you aren't removing?
How correlated the variances of them are.
Okay, how
right? Because we talk now about dispersion trade. So we trade variance against variances. Right? So the question is how much these variances in the fund are moving together, not just the underlyings moving together. Yeah. Typically it would work the same way, right? If underlyings go one direction, the variances would also go on. If underlyings are very correlated, and if they all go down together, all the variances typically will go up, normally because of a symmetric volatility effect. But as usual, there's one but, right? It's not, it should not happen theoretically. It might happen completely differently. And that's why we should look at the correlation between variances. So we should look at the factor structure of the variances, because variance is now our asset that we trade. We don't trade underlyings anymore. We trade variances, and that's a different asset class. So we should look at the correlation between variances.
Okay, that makes a lot of sense. Maybe we'll pivot slightly here because we've mentioned it a couple of times now. You know, balancing the theoretical and the you know, the practical. When you're thinking about trading in general, how do you weigh the two against each other, the theoretical and the practicality of an idea?
That's an amazing question. I can tell you why. So a little bit of I go to the side a little bit. Yep. I know lots of my colleagues and lots of lots of academia never had any practical experience. They're still amazing researchers. I mean, many of them involved in some policy work and some economic regulators work and so on and so forth. But many of us write papers about trading, about optimal portfolios, about some trading signals, never actually trading anything themselves. And it's really funny because sometimes they're good papers, sometimes people are right. But if you look at these papers and you see, okay, can you really implement it? Does it really work? And you try doing it, it typically doesn't work. There are many papers that we have written in academia, they are based on some unconditional evidence. So what is unconditional evidence? Let me compute the risk premium for some factor. I don't know, momentum. Oh, there's a positive risk premium. So it means that if you have high momentum beta, you expect it to get some profits. Okay. But there may be different periods, right? There may be like 5 years, and that's what happened. Like we had like 50 years of momentum being positive, and then suddenly there was momentum crash. So the average premium or average realized premium was negative. There are many other different factors which may change the sign of the premium over time. Now everybody's going crazy about ESG, right? Environmental, climate, carbon, whatever you call it, all these kind of factors. And we see lots of papers written and saying, yeah, the risk premium is positive. And some other guys say, no, the risk premium is negative. Look at these risk premiums. Okay, we have also a paper, we contributed to this kind of literature when we looked at the measure extracted from the conference calls, and we computed the risk premium for this particular attention measure during conference calls. We see that, okay, unconditionally, there is some risk premium. But if you look at the time series of this risk premium, it basically was 0 before 2007. Then after 2009, it went up quite a lot. So it was positive for a number of years. And then at around 2015, it went down to almost 0 and stays there until now. Okay. So if I just give you a number, say, yeah, the risk premium is positive over these 15 years, which I tested. So if you invest in this kind of stock with this characteristic being high, you would be making money after you control for all these factors which I control for. But then if I show you conditional analysis, it's not going to be the case. And last 5 years, you expect to make zero.
Mm-hmm.
Another example, I can tell you, you mentioned the paper I wrote about implied correlation, but some time ago I was considering myself a skewness guy. So basically, I have a paper on implied skewness, and my co-author actually, because of that paper, got a job in a very large hedge fund,
Nice.
one of the top 5 hedge funds in the world. He was trading this strategy for many years, actually, and it's worked, okay, based on implied skewness. And implied skewness works in the cross-section, right? So typically, we show that stocks for which the implied skewness is high today would outperform stocks for which implied skewness is low today in the next couple of weeks, maybe months, maybe 2 months. Then the signal disappears. It's relatively short-term signal. On my website, I have the data for all this implied skewness and even decile portfolio, quintile portfolios based on skewness. And then I show the graphs. I show the unconditional graph of, say, high skewness portfolios and low skewness portfolios. You see amazing monotone relationship. It's based over the last, 25 years from 1996 when Option Metrics got the data.
Yep.
However, if you look inside, if you look at the last like 2, 3, 5 years, it just doesn't work anymore, right? So again, going back to the main topic of the discussion, there is a big difference between academia and the real trading. It is very important to read research to stay up to date, but we always have to read the papers with a little bit of skepticism, right? Being a little bit skeptic. And certainly, again, one of the questions that we discussed, that we will discuss today, is how to get from research to real strategies and to practice. One should definitely have a very good framework for testing this research. Framework, I mean that one should get a very good program or a set of procedures, which allows you basically to connect your data easily by writing a very simple adapter depending on the data, right? Mm-hmm. Then you would need some code, which is more or less universal, where by simple configuration or just by saying what you do, you compute some measures and metrics that you want to use. Then there should be some backtesting module, right, which basically backtests your signals based on the standard output from your characteristics. And then you should also be able to take this to trading, right? So if you have this system developed, then testing a paper, if you have some data already, right? If you can get the data, which nowadays is not a big problem, right? Yeah. So now we have, if you don't have access to the academic research data like WRDS, so then there was Quandl, which is now being bought by NASDAQ and others. So there are lots of databases around. There are actually too many probably, but you can get the data. So if you have this nice system of testing, you can test almost any strategy within a couple of days, right? Mm-hmm. Because just writing an adapter for the data, okay, a couple of hours. Programming how these different measures are computed, if you have the data, typically it's a matter of hours, right? Then adapting to the frequency, just making everything clean, and debugging for a day, right? The largest chunk of data, chunk of time that you're going to spend on your program will give you already all the results. And in most cases, if you take, say, 100 papers, maybe 5 of them would be robust. Mm-hmm. If 5 of them would continue working, unless you also overfit, same as the authors did. But that's how it typically works.
Okay, I think that's pretty interesting, and we actually saw that ourselves. Recently, we tried to work with the community to build a strategy based around the overnight risk premium, more or less. Okay. And what we found was we found like a momentum factor was a pretty good predictor, sort of doing like a last 30 days predicts next 30 days pretty well. And the results were insane. This strategy was going to make me rich. And then we started to actually try to implement it. And what we were really looking for was slippage, right? We had assumptions about fills. And then when we went to actually implement it, we saw that the fills that we were getting actually were much there was a lot more variance in the fills than we assumed there would be. Like some people would get great fills, things were looking good. And then some people's fills made the strategy terrible.
Yeah.
And when we averaged it all out, we sort of saw something similar where there were periods where the strategy performed unbelievable. And then there were these long 4 or 5 year stretches where you were flat or losing. And these would be even during periods where the market's rallying.
Yeah.
Right? Which, was quite the challenge was quite a tough pill to swallow. I was
No, absolutely. And you see,
really,
if you're a very large hedge fund, which has like 50 strategies running simultaneously, and you allocate to each of them like 1-2% of your capital, and one strategy doesn't perform for 2-3 years, okay, 2-3 years is already critical. Let's say like 1 year, you can tolerate that, right? You can say, okay, good, it's still hedging my overall portfolio. In some other year, this strategy will perform, the other will not. But if you relatively small investor, which can only run 2-3 strategies max, right, simultaneously, then it's certainly a big deal.
Yeah, it's a huge deal, right? And but on the flip side of it, all strategies or most good strategies have drawdown periods, right? Not everyone's going to make money every day. So how do you sort of balance the two when you're looking at, let's say, a back test? Obviously, like 3 years of drawdown is obviously too much, but for example, like a deep value strategy would lose for 10 years and then have 1 year where it makes 500%. But we understand the nature of the strategy. So how do you sort of think through that?
I guess very important for all of us to understand that risk and return are very much related, right? So if anybody tries to start trading and expect to earn 100% per year or 50% per year or even 30% per year, then he or she is taking a very large risk, right? So then the drawdown of pretty long period can be expected, right? So if you're large funds managing billions, and you have a drawdown limit of like 2%, then you certainly cannot go or take the same risks as typical private investors who are also lottery seeking, right? I mean, most private investors are seeking some lotteries, are taking. Okay, if you ask about how I do it, what is acceptable drawdown for the strategy on the back test? I mean, if it's half a year, again, personally, I can live with that.
Yeah.
Right. But after 2-3 months in real trading, I would already start getting worried. Okay. But if it's a 1 year, I certainly would not go for it.
Yeah. And
unless this strategy is kind of a conditional strategy for which I can easily identify risk on, risk off regimes. Right. So then the strategy would be basically switched off for some period, say in high inflation periods, right? Some strategies don't work, I just turn it off. And until the inflation goes down below like whatever, 2%, I will keep it sleeping.
Got it.
Then it's okay.
Yeah,
but again, it's very easy to do on the back test.
Yes.
It's very easy to overfit. Even though you say, yeah, well, I will not overfit, I will not tune some parameters, I will not do that, I will do some validation periods and some other periods, but still we all overfitting, right? Because we want to believe into the best. Okay.
Yeah,
That's
exactly. We want it to be as good as possible, and just by
Absolutely.
the nature of that, it's
absolutely.
One way that we try to sort of overcome overfitting to a degree is start with the logic of what we're testing, rather than like throwing a bunch of data against the wall. I feel like that helps to a degree, but it still ends up happening with the way we adjust.
I can tell you, I was developing now since April a new strategy. Basically, just put it to production pretty fast, like two months. And I tried again. There is some logic in the system. It's more or less short-term momentum, relatively standard, but there is some mathematics inside. Okay, so I tried to be smart about it for once. and strange thing is that when I try to be very smart, When I say I build some distribution and I see the distribution is not nice, and I try to make it nicer so that like theoretically proper and everything breaks down. Just doesn't work. If I keep everything ugly, is like without much processing, and I know that, yeah, distribution is not realistic, it's somehow strange, but that's what data tells me, then it works.
Mm-hmm.
Okay, so it's again, overfitting is a big problem in all the strategies. I've been stepping on this many times, right? And when you see everything working very well in the back test, and then you start trading and suddenly it doesn't work anymore. And then the question again, how long would you want to wait until you kill the strategy, right? If you really believe in your back test, if you really believe that conditions on the market did not change, that market microstructure did not change, the same people trading the same markets, the flows are similar, everything the same, then basically, if you really thought about what you did and if you believe in it, it should work. Okay. Then you might keep it alive, but then it's still very, very hard.
And I guess like you're saying, it's like, and especially if you have maybe another strategy that wins in other periods of time, right? Then it becomes a lot. That's why when you have 50 strategies running in a fund, you probably have a longer acceptance period of something not performing well than a retail investor who has one or two strategies running.
No, but if you have many strategies, you can also do some capital allocation among the strategies, right? So basically, there can be some flexible rule also based on some rolling window. Say you compute your Sharpe over the last quarter, and then you just allocate the capital for the next months based on relative Sharpes that you get, or relative on some tail risks that you experienced in each strategy. So there are many rules you can come up with. Certainly it helps, right?
Okay, so I want to ask you about something. You mentioned it very briefly, it just sparked an idea of what we could talk about, is the risk parameters around hedge funds, right? It's like, if you have if you're managing a strategy for a hedge fund and you have a 5% drawdown, they're probably pulling some capital from you, right? So there's these constraints around risk that they face that the average retail investor doesn't.
Oh yeah, absolutely.
Right. But what that kind of leads to is, when thinking about where opportunity lies for retail traders, where opportunities to be found, do you think it's worth looking into areas that maybe have more variance in the returns because there's less sophisticated money able to trade it?
Yes. While it's not very scientific what I'm saying now, and I would certainly advise my students against that, right? Because we always teach, yes, you should do some nice mean variance portfolio, you should diversify. It depends on your horizon, depends on how much money you want to put in there, depends on what a fraction of your capital or your money you're putting into some strategies, right? If you trade on everything you have, you certainly shouldn't take much risk. If you trade on like 5% or 10% or even 20% of your capital, then I personally believe it's okay to take more risks, right? Because large hedge funds, again, there are lots of different hedge funds. If you're a small hedge funds with like 5-10 million under management, or huge hedge funds with billions and billions under management. So these big guys, they have really, really strict constraints on the risks, right? So they have drawdown constraints, they have risk constraints to factors, they have lots of constraints, right? So I have some not evidence, but again, I have some friends in the large hedge funds, and they say, okay, if they show drawdown of 2%, that's it.
Yeah, goodbye.
Yeah, goodbye. So basically, your strategy doesn't belong to you until the end of the year, or until they figure out. I mean, your management figures out what's happening. It's typically frozen or liquidated or something, right? But there are certainly many smaller hedge funds which don't care much about this kind of risks, which are more like friends and family, or like 50, 100 million. They might have a drawdown of 10%, of 20%. again, you look at this ARCs funds investing, right? I mean, they lost how much? 50% last year or this year.
Yeah.
And still okay, right? Still surviving. Some funds been closed, but this high tech fund is still getting some inflows, right? So they're certainly not killed. So there are different regulations and different norms for all kind of different funds. But in terms of private investors, certainly if you have only $100,000, then trying to make 4% per year with low risk, it probably doesn't make much sense. Right?
Yeah.
You certainly want to have higher risk because risk is typically proportional to return that you might get from the strategy. It doesn't mean that one should start buying lottery, like in whatever sense, start buying lottery as a real lottery, or start buying some or selling some tails all the time on the option markets, right? Because you certainly can make lots of money. You can make several 100% per year easily until something happens. And the bad news is this something typically happens, right?
Yeah. People forget that, right? They forget that it's like, if it happens 1% of the time, it's not like it's never going to happen. It's going to happen 1% of the time.
You know? Absolutely. I mean, certainly you can, if you have some strict rules, you can come up with some rules. Yes, I have to stop here, but it's like a casino, right? Typically people still lose because they still want to make more money, because they start feeling that, yes, now it's so easy, they're always right. I mean, if you write 10 times, you're certainly going to be right the 11th time. It's not a big deal. But then exactly this 11th time, something happens.
Yeah, so let me ask you about this. So speaking about these more like higher P&L variance areas, you know, one of the things that you know we talk about a lot in our community is earnings trading, for example, right? Basically selling vol across a lot of earnings events as like a form of diversification, and then there's basically a bit of like a earnings risk premium, a jump risk premium, more or less. Are there any other areas that you think are interesting for people to look at if they're in the retail space, maybe trading somewhere between like a $50,000 and $250,000 account?
When you say selling variance, you talk about selling variance, or you're selling options?
Selling the options, like selling straddles, selling the implied move, basically.
Yeah, but it's still, if you sell even if you sell the straddle, you delta neutral at the moment, but then next morning you can be not delta neutral. So it's quite different from selling the variance still. Yeah, right? You still sell lots of underlying risk.
Yes.
No, but in general, selling options, again, in 2022, it is extremely risky, but selling variance, hedged or non-hedged, is typically, again, if you keep risks under control, it's typically a good strategy. It's not universal. You should not just sell everything. You should certainly think, you should analyze which companies you can sell, which you cannot sell. For some, you can sell some tails, but you certainly can collect some risk premium, right? Selling the same out of the money puts. But again, it's very, very important not to oversell them and keep everything under control.
So a couple questions coming out of that. One is, as a retail investor or trader trying to price volatility, figure out where I should be selling, what do you think are some good ways to go about doing that? Right? If we're trying to say, like, is this cheaper?
I truly don't think there are any good ways of doing that.
Yeah.
No, I can basically tell you, you can build a model, some autoregressive model for volatility, for variance. You can include some macro variables. You can include some other market variables. If you're ever going to be right, yes, sometimes you're going to be right. If it's going to be about 50-50, yes, I believe it's going to be about 50-50. So it's selling volatility at the right point. It's the same as selling market at the right point.
Yeah.
Or buying market at the right point. Market timing is extremely hard. It's basically impossible, right? Typically, we know, again, how smart traders work, many smart traders. I mean, you read the books, right, about famous traders. If there is a trend, you can run the trend, right? You cannot guess typically when the trend changes. So you see the trend, you can buy. You go, volatility is going up, and you see that it's going up for some time, or it's going up before some events, typically, right? You can buy volatility. Right? If volatility is very high before the event, and then you know that in 90% of the cases, volatility will go down after this event, you probably can sell volatility.
Yeah.
right? But
Yeah.
again, selling volatility using straddles, it's a little bit tricky because you're still not delta neutral after even a small move,
right?
right?
And and that's like one of the tricky things as a retail trader is maintaining that neutrality on delta. And so, what are your thoughts on that? In one of the things I was thinking about your delta is it increases your like P&L variance because you're not delta neutral anymore. But over like a large number of positions, you probably still get close to like the same point in terms of your returns. And obviously, we don't say like never delta hedge, right? We try to encourage people to think about their risk exposures.
Yeah,
How
absolutely.
do you think a retail trader should go about managing their risk exposures?
I mean, typically, you would set some limits within which you can keep your delta unhedged, or not unhedged, but not rebalanced. Right? So if you say you want to keep the delta close to zero as much as possible, you certainly can go to like plus 0.1, minus 0.1, probably. It's not such a big deal, right? But again, it's also compared to the variance you're buying and selling. If you expect there is a high variance risk premium, then these bounds for delta hedging can be wider. If the variance risk premium is very low, then probably, okay, there's not much sense in selling this variance. This is first.
Yeah, exactly. It probably starts.
And second is, because you're going to lose lots of money on delta hedging. And then the problem is that, again, this year in 2022, volatility is very high for many stocks. It's gone down last couple of weeks a little bit, but many stocks behave crazy in a crazy way, right? Because so many factors. Implied variance is pretty high, so implied vol is pretty high, but realized vol is also pretty high. I did not truly compute the realized variance risk premiums for this year, but I believe for many stocks it's not going to be positive.
Yeah,
I'm not sure if
so
you
far
did.
in the year. Yeah, I think things have picked up a little bit in the last month and a half.
Yeah, just because the variance went down a little bit. Implied also went down, but implied is typically lagging, so that's why there is some risk premium. But ex ante, you cannot say what's going to happen in the next couple of months. So this year is just very tricky. It's very, very risky. Because I've been also selling the volatility pretty successfully last several years. But yeah, 2022 was not a very good year.
It's been especially the first half was a bit of a nightmare, but it happens, right? It's the thing I think about is it's periods of time like that, which is why the variance risk premium exists.
Absolutely, exactly, because this is the risk.
Yes.
And there is a payoff. If you want to sell hedge to somebody, if you want to sell insurance, then at some points they will demand the payoff.
Exactly, right? There would be no car insurance if people didn't crash cars.
Again, and many people, many traders do not understand that return is always risk. Right? If you're getting today 50% per year, it means that next year you can lose 50 or you can lose 100. Right? If you go into the strategy which assumes such a high risk, then there can also be potential losses, also very high.
Exactly, right. And it's sort of like a balance between what drawdown can I tolerate and recover from and maximize my returns off of that.
Yes, absolutely.
Right.
It's like in 99, 2000, 2001, I was exactly doing my MBA in Rochester, and it was a tech bubble, right? And then I just remember, that's when I looked at the equity markets for the first time, because before I was trading forwards on the Forex. And in the States, exactly, I said, everybody was telling me, I mean, pure students, say, yeah, just buy anything. It doesn't matter. It's really, you don't need to analyze anything, just buy. And that was the truth. I was basically buying something and it was going up in a month and I was selling it, right? But then I kind of forgot about my trading account. There was not a very big amount there. And I looked at it in a couple of years, it was almost zero.
Yeah, you're like, wait a minute.
It was going up and up and up and up. And then, hoops, the risk realized. So it's very important to understand that all the high returns we're expecting are associated with very high risks. And the higher is the risks, the higher is the probability that large losses will be realized. So that's why hedging, selling the tails is lucrative until the tail event happens. And when tail event happens, you better be hedged against it.
Yes. So one of the things that I've heard from a few of our members recently, and it makes sense why this isn't a challenge for them, is position sizing, right? Trying to think through, like you were saying, it's like, okay, like sure, if you're going to be selling tails, okay, I understand it. Don't be careful about what size you're selling tails in, right? And so when you're trying to think through how to actually size these trades, do you have any advice that you could give to our members?
I mean, many brokerage companies and probably many sites which also help investors to select the sizing and analyze the trades, they have some sensitivity analysis. Right? So basically, it's very easy for any portfolio, whatever complex it is, however complex it is, to see what's going to happen to the value of this portfolio if the stock moves 10%.
Yeah. So basically, just stressing
10%. Okay, 10% is pretty extreme. It can happen, right? So you should always take into account several scenarios. One would be like extreme, 10, 20%. I mean, during COVID crisis in March 2020, we had minus 20% on NASDAQ, right, in a couple of days. So it's extreme, but it may happen. Then it was some good recovery after that. So it's probably not, unless you highly leveraged, it's not such a big deal. But otherwise, 5% move to 10% move in individual stocks is pretty realistic, right? So then you should just see what happens to your portfolio if there is a 10% move. And if you lose half of your portfolio, then you probably sold too much.
Yeah.
Right? Then you just think, okay, how much am I able, or would I be willing to tolerate, right, if this happens? Say I can tolerate, if I'm doing some weeklies, right, some weekly options, or within a month, I would say I can tolerate on my private portfolio like loss of 10%. Okay, so then it's for some realistic moves on the market, say like 2 sigmas or even 3 sigmas, I can see then how much I can sell and what kind of risk premium I can get. Right, but then I always also have think about some contingency scenario. So what will I be doing when the market goes south? Right, will I be continue keeping these positions, or will I just have some stop loss and kill everything, or will I lever up?
Yeah, exactly.
And it depends. I mean, certainly we know that this martingale strategy in the casino, levering up basically doubling all the time, it's extremely risky. Sometimes it works. I can tell you, I was sometimes making like really very good profits on doing it when the market recovered or rebounded. But at the end, I lost everything on that particular account just because it didn't recover.
Yeah.
So you just need to live with that, just understand what can happen.
Okay, that's really good. I think it makes a ton of sense. It's almost like have a decision tree. Right? What are you going to do under different scenarios? What happens to your portfolio if X or Y situation occurs? And then sort of just you're able to like step back and look at it and say, is this acceptable to me?
Yes, absolutely. But again, the main recipe for all of us, or the main instruction for all of us, we have to understand what kind of risks we're going into. And one of the best measure for that would be simple sensitivity analysis, right? Take the worst conditions you might observe in the market tomorrow. Let's say everything is highly correlated. A correlation shoots up to like, I don't know, 90 or 100%. Everything moves simultaneously down. Volatility spikes, VIX goes from 20 to 40. What happens? That's probably the most extreme scenario.
Yeah.
I mean, the most extreme is much worse, but I'm not going to talk about it, right? But I mean, this is bad and extreme scenario, but pretty realistic because we have observed such scenarios in the last 15 years, probably 2-3 times in the last 20 years.